So this is the flyer is actually on our Facebook page, YouTube's, and all over the place. So again, take advantage of it. All right. Now, as a commercial broker, the most important thing for us is to be able to get deal done, and that is very, very important. Oftentimes, you will hear many people saying that, oh man, if I go to the bank's rate is this. I got much lower interest rate, than you guys, so on and so forth. But that is all good. The bottom line is that can they get the deal closed? In commercial lending, unlike the residential agency funding, there's so much unknown variable to it. There's so many moving parts. And that is why we need our lender to actually work together with us. Now, quite frankly, a lot of the business owners, when they go to the bank and asking for funding, yes, they do have the best and lowest interest rate. But at the end of the day, what good is it if they cannot get a deal done? Because when you go to the bank, guess what? The bank is 9 to 5. After the 9 to 5, they do not work for you. You do not call them on weekends. You do not call them on holidays. But with our lender, most of our lender are private lenders. They work just like you and I. They work seven days a week. They work on weekends. They work on holidays. But the most important thing, many of our lenders are willing to go that extra mile together with us. We know how difficult it is for you to bring in that client. It's not easy. And you rely on us to get that deal closed. So on our side, as the corporate office, we walk that extra mile, not even 1 mile. We walk that extra 10 miles to try to get that deal done. But same thing with a lot of our lenders. They are willing to work together with us to make the deal done. So perfect example. 2 weeks ago, I shared with you guys there's a shoe store gentleman that purchased a retail property to move his business into that property. Everything's approved. At the last minute, he told us that, hey, Alan, I can put down 50%, but that 50% is in the form of cash. Can you do it? And guess what? 99.99999% of the time. And if there was other lender involved, most likely that deal is dead right there and then. But however, with this lender, we brainstorm, we come up with all kind of creative thinking. So at the end of the day, we were able to close it. How can we approve that cash is his? So we ask the client, have his cash in front of him, take a picture, show that he really owns those cash. Which lender can do something like this? Honestly, I have been doing this thing for over 20 years. This is my first time close a deal like this. And that is demonstrate that our lender is willing to go that extra mile, push the envelopes to get this thing done. So with that being said, I'm introducing tonight's speaker. We become friends. We pretty much talk on a day-to-day basis. We close all sort of deals. That particular deal, having the client in front of a pile of cash, is his idea, and he made it work for us. And now the biggest deal that we are working on right now, it's $100 million deal right now as we speak, and he thinks that he can put that deal off. So without further ado, it's my greatest pleasure to introduce a very good friend of us, a very good lender of us, Mr. Carl Shirley. Carl, the floor is yours.
Alan, thank you. Appreciate it very much. Thanks for giving me the opportunity. And thank you for the great introduction. That was well done. So my goal tonight is to teach everyone and give them some idea of how a lender thinks. Our goal is to make a loan. Your goal is to have the loan made. That's the only way we both make money. So I'm going to give you a brief 25-minute example of what we do, what we need to do, and a little bit of instruction, so that way you can see what a lender thinks like. If you think like we think, it makes it so much easier to get the deals done. So I'm going to run through this whole thing. If Alan, if you want to share my screen with everyone, I can start the presentation.
Yes.
Let me know when we're up.
Yes, you can share now.
Okay. So I'm going to go over some things. I'm going to go over how to qualify potential deals, the different loan types that we offer, and how rate differentials are affected by those loan types. and then I'm going to show you how we begin the lending process. So what we're going to do is we're going to go over qualifying potential deals.
Carl, we don't see your screen yet.
Did you share with? You didn't share?
I'll give you the access to share.
All right. Let's try screen. Then we go over sharing.
Yep, there you go.
Okay. All right, so we're going to qualify deals, go over the loan types and submissions, and we're going to show you the lending process. All potential deals are judged according to the same criteria. It's just that those criteria change. Credit of the borrower, credit meaning the credit score, and in commercial, we also use a thing called credit profile. Profile, as I'll explain coming up, also includes their liquidity and their net worth. And then we use the income of the property and the type of collateral. So, different levels of credit. Unlike residential, commercial has different scoring tiers. Typically, most borrowers that we see are in the A- or A credit ratings, as you can see the numbers above. A credit, typically 800. A- credit, typically 700 to 749. B credit, 650 to 699, and so on. And what I was saying just recently about profile is the liquidity of a borrower and the net worth of a borrower affect what we think about that borrower. So in residential, you may say the borrower has a 750 score, he's buying a home, this X on the matrix is where the rate falls. The liquidity and net worth help us adjust the rate. Every deal that we do is underwritten. So now, when we do income, there's different ways of looking at income. We have borrowers DTI, which is their debt to income, which people who do residential are very familiar with. We have the property's income, which we term as DSCR. That stands for debt service coverage ratio. That shows us how much income comes from the property and how much we can use that income to pay for the mortgage payment, the other expenses such as real estate, taxes, insurance, and utilities, or a combination of the two, which is called global. Global comes into play when we have owner-occupied businesses. Owner-occupied businesses allow for the owner's personal income, which is derived from that business, as well as the business income that they declare on their taxes. So ways of generating income is pretty much self-explanatory. We have property types and collateral. When it comes to property types, we rank property according to its most desired type to its least desired or highest risk type. And then beyond the high risk is special purpose. So type A properties, typically mixed use properties with a lot of residential, multifamily apartment buildings of 5+ units. Units of 1 to 4 in residential are considered investment residential and not commercial. Type B properties, we have retail properties, office buildings, mobile home parks, warehouses, automotive properties, and mixed use with less than 50% residential, which shows most would be the commercial portion of the property. Type C properties are restaurants and bars, bed and breakfasts, daycares, car washes, and light industrial. These present a high risk. So since there's such a high risk, we will adjust the rate accordingly. So type A properties may have a rate of X. Type B properties would have a rate of X plus 50 basis points to 100 basis points. Type C properties would have an add to the rate on top of that. Type D properties are special purpose properties known as funeral homes, nursing homes, assisted living, which we only do if there is no medication distributed on those properties. Mobile home parks that have an RV component, since RVs have the ability to just turn the key and drive away, they present an additional risk, so that becomes a type D property. Hotel, motels, event facilities, wedding venues, and gas stations are also type D properties. Gas stations are difficult to get done because the most that we can do with a gas station is typically an SBA. So for an SBA loan, the borrower would need to be bank qualified. So with a bank qualified loan and an SBA loan, the difficulty there becomes greater, and that is one of the hardest properties to get done. So we always say, always ask, is there an alternative use for the property if the current business moves out? You may have a funeral home that is always going to be a funeral home. But if you have an event facility and that event facility can be used as a warehouse, we might be able to bump that up into a different category and give you better pricing based on the highest and best use. So these are just a couple properties that we had local to us that I took a few pictures of so you can see them. This is just an event facility property, and the other pictures were just some aerial pictures. This particular property, if you look where the aerial picture has it highlighted in white, the other properties are directly behind it, and they were all owned by the same person. We divided those properties up based on their usage. The event property was used as a type D, but if you look at the white space down at the bottom where there's a small building in it, that is an automotive property. We were able to use that as a separate property since it's on a separate parcel and use that as a C. So this borrower got a combination of different programs, and it just shows that our ability to try to help the borrowers by giving them multiple options. Instead of grouping them all in a type D property, we were able to lower their rate by separating the properties. So we have different loan programs. So we're going to evaluate the income, the credit, the collateral, and make sure that we have a closable deal. And the whole thing about being a mortgage broker, a real estate broker, insurance agent, or whatever the case may be is you have to look at some red flags. The typical red flags we see when we take in applications are bankruptcy, low credit or no credit. Typically, we need to see at least 2 credit card trade lines, and we prefer to see a mortgage trade line within the last 2 years with no mortgage lates. We do make exceptions for those, and those exceptions do affect the rate. Foreign nationals are difficult to get done. They are eligible for certain programs, typically the 1 to 4 unit residentials they're eligible for, and any commercial property where they have a partner who either is a green card holder, resident alien, or has a U.S. bank account and reports U.S. taxes. So the IRS being involved with U.S. taxes helps us get past the foreign national difficulty. Another problem was mortgage lates. If there are mortgage lates on the credit report, we will permit 1 mortgage late in the last 24 months. Anything over 1 mortgage late adds risk to the file and would need underwriter approval and an exception, and a rate adjustment would be qualified higher, usually 1 or 2 percentage points for those lates. And the biggest red flag that we see nowadays are old appraisals. We're constantly getting appraisals from other brokers, other lenders, saying that they can't do the deal, and then they bring it to us. The deal has been shopped. The deal has had enough information given to a lender to order an appraisal, and now the deal can't be done. So we will try to make exceptions, and we lower our loan to values, and we do sometimes accept an old appraisal from other lenders as long as we can prove that the appraisal is done by an approved MAI appraiser that is on our list, and we are comfortable with the property in the scenario. So we are willing to go the extra mile when other lenders say no. And that includes banks and private lenders. So we have different types of loans. We have full document loans, stated income loans, low document or low doc, and then bridge loans. And I'll go over the requirements for submission and what it does to each rate for the borrower and their loan. So for a full document loan, we typically require a commercial loan application, a current tri-merge credit report, profit and loss statements, rent roll, which tells us who the tenants are, and the rent rolls should also include vacancies so we can see the total number of units in the property, bank statements, typically 6 or 12 months of bank statements, and 2 to 3 years of tax returns. This is typically a conventional style loan. It beats the SBA going rate. So that's why we as a private lender or alternative lender have programs like this, because even though the bank comes out and says that they can do a deal for an owner occupied property with a bank rate SBA loan, they're now typically prime plus 1 or prime plus 2. That would put them at 10.5. For a full document loan on an A borrower with an A property, we can be in the sevens. So this is an aggressive program that we have that fights the bank programs when the bank feels that SBA is the only thing available. Stated income. The stated income program is typically what it says. The borrower gets to state on the application what their income is, state on the application what their assets are, and we don't verify those. Sounds a little risky, and it is, but the stated income is the highest rate of the available loans that we offer because it assumes the most risk on our part as the lender. The requirements are no tax returns. Typically, we just require the commercial loan app, the credit report, and a profit and loss statement with the rent roll. So we allow the borrowers to fill in their own numbers in the profit and loss. The rent roll must be verified by the appraiser, so we will verify vacancies and occupancy. And we will use the appraiser's value for what he thinks or she thinks the property is generating an income. The appraiser will do in the appraisal the income portion as well as the sales portion to get their valuation. In that income portion, they will take the gross income of the property and subtract the expenses that they think are market expenses. So they take market rents minus market expenses. And that's how we come up with our valuation. So while we allow the borrowers to state their income, so to speak, as this is called, we also use the appraiser's numbers from the appraisal to verify that those numbers are correct. Low doc is a combination of the full doc program and the stated income program. It requires the commercial loan app as all the others do, along with the credit report, and a profit and loss. This is what we use to justify the rate for a low doc, which is somewhere between conventional and somewhere between stated income. The low doc rate is what we would call a soft money rate. There are no tax returns required for us to quote or guarantee rate for the program. The only time that we require tax returns for this low doc is during the processing. And the reason that we do that, we don't look at what they say, we just look for proof that the borrowers are current filers. We don't lend to anyone who is a non-filer, or if they are a non-filer, we put them in a different program, which is hard money. And in the low doc program, we have a lot of exceptions. And Alan gave you the best exception that we have ever granted in the history of our company, which was for him and his client. And that's one of the reasons that we've become such good friends over the period of time, is because Alan knows we're willing to go the extra mile to make things work. So the reason that we asked the borrower to show us the cash was multiple reasons. Typically, when we're going to closing, the borrower has money in escrow for the proof of funds. At this particular time, there was no proof of funds available except for the borrower's admission that he had cash. We typically see people say, we're going to bring money to the closing table, but they borrow it from a friend. When they borrow it from a friend, that makes that friend a partner. So we would need that person in the loan. In order for us to verify that this gentleman was not bringing in money from an outside source, borrowing money from a relative, getting money somewhere else, and it was his money, he put the money on the picture, and the picture is what got him through because we proved that he did not have a partner. So that was one of the greatest exceptions we have ever granted. Bridge loans and hard money. Bridge loans and hard money can fund as little as 14 days. They're typically for bank turndowns, bankruptcy, liens, list pendants, judgments, collections, or bad credit due to divorce. We often see a borrower who has gone through a divorce and did not realize that a credit card was still in the hands of the other spouse. The other spouse was ringing up credit card bills unbeknownst to our borrower, and all of a sudden the credit goes from a 750 borrower to a 550 borrower. These are the type of loans that we give until the credit repairs are done, divorce decrees are handled, and then we can get the borrower out with a more conventional style loan. So for bridge loans and hard money, typically we require the story. There's always a story that goes with these loans. And Alan can tell you that we've heard when you thought you've heard every story, there's always another story. So we'll take a 2-paragraph example of what the summary is and what the problem is that we need to resolve. Once we review it, we'll decide what the documentation that's necessary is. Since each deal is unique and stands on its own merits, we'll require different items. It could be tax returns, because there's a saying in our business, hard money is not stupid money. We want to see that we're going to get paid back. So we'll look at different things, whether it be tax returns, past history of the borrower on mortgages, mortgage lates, and a different kind of amalgamation of all of the borrower's available information. So let's begin with the lending process. I'm going to show you how we get this through, what we look for, and how a lender evaluates all this information. The first thing you do is when you talk to the borrowers, you need to qualify the deal and make sure this is a deal that actually can be worked on and can close. One of the things that Alan told you in the beginning of this presentation was we have to set realistic expectations for borrowers. The borrowers are expecting, because they hear on TV, they read it in the newspaper or anywhere online or any social media, that I have just gotten an offer of 6%. Well, there are no 6% in the market anymore unless you're getting a residential loan for an A borrower in an A area with an A home. The quotes that people give aren't always what the borrower is going to wind up with. So we like to underpromise and overdeliver by telling a borrower what we think that their qualifications and factors are, and how we can help them get into a program. If we can get them into a stated program because they have a cash business and aren't declaring all the money, or they have a cash business and what we say is they're taking full advantage of the tax code, we can steer them into a stated income loan, with the option that when we're gathering information, if we find out that the borrower has tax returns, profit and losses, or anything that can put them into a low doc and move them up one grade, we will do that. We can always go from stated income to low doc to conventional. That way is okay. However, we can't go the other direction. We can't try to get a borrower a conventional loan with a low rate and then find out that the borrower does not qualify and try to put them into a stated program. We can't unring that bell once we know that the borrower doesn't make the money. So that's why we always start out with the underpromise, overdeliver motto, saying, hey, let's try the stated income, and if you qualify for something else, we'll put you into that other program. The second item after that is to give us a 2-minute call, or give Alan a 2-minute call, and figure out what program it is. Now that you've figured out the information from talking to your borrower, the best thing to triage the deal is to take a 2-minute phone call or just an email with some pertinent information, a couple items like tax return information, credit information, property location, and whether or not the property is an A quality B, C property that needs any maintenance. They're the things that can throw us off. So that's the second thing that we do. And that'll save us time at the end, because now we know we're working on a deal. So for the application process, you've got loan type, property type, credit scores, and income sources. And those are your 4 key items to getting an application done. So always think like the lender, and you'll have more success in your loan programs. So once you submit everything, typically we approve it in 24 to 72 hours. And what we always say, we have a quick saying, it's no phone, no loan. For borrowers who want to communicate via email all the time, we find out that there's always something that they want to hide. And the bigger hurry they're in, the more that they're looking for you to overlook something and make a mistake. So we underwrite every single deal. We don't have a pricing matrix. We take our time, we look at all the information, and then we give them the offer. Typically, it's 24 to 72 hours. So then once we give you the offer, you're going to present that to the borrower, and we're going to explain the terms, such as the fixed period. Obviously, if we have a 5-year ARM or a 3-year ARM, that's a 3 or 5-year fixed period. And after that period, our loans adjust. They do not balloon. The only time that they balloon is if we put them into a government or agency Fannie Freddie loan. At that time, there would be a balloon. But for all intents and purposes, and for this particular presentation, all fixed periods are fixed at 3 or 5 years with an adjustment either quarterly or yearly after that. We explain to them the amortization period. Typically, we run a 25-year AM or a 30-year AM. 30-year amortizations have a smaller payment, so therefore they have better cash flow and can yield more proceeds to the borrower. 25-year amortizations have a lower rate, but have a higher payment. The prepayment penalty, there's always a prepayment penalty in a commercial loan. Unlike residential where they are optional, there is a prepayment penalty requirement, and it usually agrees with the fixed period. If it's a 3-year loan with a 3-year fixed period with a 30-year AM, it's a 3-year prepayment penalty. And also, if a 5-year loan has a 5-year fixed period, it's a 5-year prepayment penalty. There are things called lockout periods. At this time, we have removed most lockout periods from our loans, but you will see those mostly in bridge loans. A lockout period is an interest guarantee showing that the lender will receive payment of interest for a particular period of time. If you have a 6-month lockout period on a 12-month loan, you must take the loan 6 months, or you pay the full 6-month penalty in addition to a prepayment penalty. I'm sorry, 6-month interest in addition to a prepayment penalty. And the last thing at this stage we're looking at is the appraisal process. So for the appraisal process, the differences between residential and commercial appraisals is typically cost and length. The cost of a residential appraisal right now is running between $450 and $950. A commercial cost between $1,950 and $6,000, depending on the complexity of the property. Time to get residentials done, we're running 3 to 5 days for us. Commercials taking 2 to 5 weeks. The reason being, residentials are 3 to 5 pages, and I'm sure everybody on this presentation is very familiar with the residential. Commercials are called full narrative. A full narrative explains to us the property in multiple layers, the demographics of the area, the quality of the asset, the life expectancy of the asset, any deferred maintenance that could be there, and it gives us the income and the expenses that the market shows for those particular properties. All of those come into effect when we take the size of the appraisal and the cost of the appraisal and how much time it takes, and that's the reason why. They're usually on average right now running between 100 and 140 pages. That's a lot for us to digest, and it's a lot of information, but that's how we get our valuations of the properties. So our processing, we do all the in-house processing. The job of everyone that's on this call is probably to originate loans. We don't want you to originate and then have to do the processing of the loan. We're going to ask you for a STIP list, and we will process all the loan, and we will do all the work for you. We will order the title. We will evaluate the title. We will clear title. We will do all the processing while the appraisal is being done. That speeds up our times. Typically, a bank will take 60 to 90 days, sometimes even longer, up to 120. We will try to close loans in 30 to 45 days. All of our loans try to close in that amount of time. The reason we can do that is because we take a step that the banks don't. We simultaneously process the loan while the appraisal is being done. We take the chance that the appraisal is going to come in at value and that the borrower has estimated their value of the property in order for us to make the loan. We can make adjustments after the appraisal comes in if there are shortfalls in valuation, but at least we have all the conditions gathered and the deal can move through final underwriting very, very speedily and get it done. So closing and funding and getting paid. Closing ideally happens 42 to 78 hours after the appraisal review is complete. So once the appraisal comes in, we take 24 to 48 hours to review it because of its complexity. After the review is okayed and the appraised value has been accepted, we will close within 48 to 72 hours, which gives us enough time to draw docs and get money to the title company for closing. Funding usually happens within 24 hours of closing. And the reason we say within 24 hours is going back to setting realistic expectations. The realistic expectation of a borrower is, I want my money now. The seller of a property, I want my money now. Well, we only fund after we have proof that all the documents have been executed correctly. We will accept scanned copies from the title company to speed the fundings so they happen same day. But in some states, we are required to hold the original signatures of a borrower. So after it is FedExed or overnighted to us, we can fund immediately. So getting paid, that's the most important part. You're paid immediately upon funding. Most banks and other lenders will hold money or send wires up to 7 to 10 days after the closing of a loan. We fund the same day, so Alan will be distributing money whenever we funded him and whatever his arrangement is with his team. All right, so part two. Now we're going to get into some of the important parts. And this gets a little bit complex, but I'll run through it because we're always available for any questions you may have. But this is exactly how I want everybody to think, because when you think like I think, deals get done. So we're going to stay ahead of the competition. We're going to show you the math. We're going to show you some possible speed bumps that are going to happen. And then we're going to have a review and questions. So stay ahead of the competition. Know thy borrower, better yet, know thy deal. It's one of the big things that we say here all the time. A lot of times we see borrowers handing information to their brokers or representatives, and the representatives don't read the attachments or don't read those documents. If you read them and you know what they say, when we ask you a question, you'll know it. You'll know that deal as well as the borrower knows that deal. So it helps paint a good picture by completing the documents properly. If you know the borrower and you know the information, you'll complete the 1003 or you'll complete the commercial loan application. You'll know the borrower's assets, the borrower's employment, the entire picture, and any schedule of real estate owned that they may have. So let's do the math. There are three things that we use to figure out the numbers in this business. One is the cap rate, two is the debt service coverage ratio, and three is the debt to income, which is simplified as just expenses and income. So for cap rate, easy valuation numbers. If you divide the net operating income by whatever the cap rate of the property is, you'll get what we think the value is. It's very rudimentary and very simple to work these numbers and do them this way. But if you do them this way, you'll have a good idea of whether the deal works. And remember, you keep hearing me say whether the deal works. The NOI divided by the value will give you the cap rate if you don't have the cap rate. In most areas, low income properties have a high cap rate because there's a lot of risk. Cap rates can go as high as 12, 13, 14, 15. Good properties like multifamily properties in A areas can have cap rates as low as 5%. So it's easy to figure out. You just take the NOI and you divide it by the value, and that will give you your cap rate. The debt service coverage ratio. The debt service coverage ratio sounds pretty complicated, but it really isn't. It's just the income minus the expenses, and that divided by the expense load gives you the NOI. So in order to get the net operating income, you take the gross income. So the rents, let's say, are 10,000. The insurance is 1,000. So you take 10,000 minus 1,000 minus taxes, 2,000, leaves you $7,000 as your NOI. It's a pretty simple calculation, and they're easy to do. So the debt service coverage ratio is where it gets a little bit more complicated, but all the debt service coverage ratio is if you take your NOI and you divide it by the principal and interest payment. Sounds like it's hard. It's easy to figure out. Once you know your NOI, that's your secret to all the numbers that we use. So if we have an example of the 6-unit apartment building with $500 monthly rent for each unit, $3,000 is a month of gross rental income, minus $1,050 in expenses gives us $1,950 NOI. So a $225,000 loan at 9%, it gives us 1810 or a 1.10 DSCR. It's a pretty easy calculation. And Alan and I will always help you work through this. If you got to debt to income ratio, that's where it becomes a little bit more complicated because now we're working with someone's personal debt. At this point, I don't think it's really necessary for us to do the debt to income ratio calculations. We'll do them for you as long as you provide us with tax returns or P&Ls for owner occupied properties. We'll do all the calculations and figure out all the debt to incomes for you. They're a little bit more complicated, and it's easy for us to do because we have algorithms that do the work for us. So possible speed bumps along the way. The biggest problems that we typically have in commercial real estate are environmental issues. Previously, gas tanks on the property are a big one. We see a lot of converted gas stations that are now convenience stores, auto repair facilities, or any other type of property that they want to put in retail. What happens is, once there are gas tanks on the property and they've been removed, we are required by law and by our insurance companies that provide us with our environmental insurance to provide a no further action letter. So an environmental issue that comes up is tanks have been removed, but the state has not been contacted. And for some reason, the people think that because they remove the tanks, all the problems have gone away. So we typically give you an environmental link for the borrowers to answer the questions. And if we find out that there's a tank on site, we will do all the back office work to find out those environmental issues for you. Title issues, more than one borrower on title. Previous loans were not satisfied. We handle those as well. We'll take care of those. But every one of these is a speed bump that creates things, creates a problem and gives us needs requirement for more time. Typically, the biggest one we see for personal is back taxes. We typically only allow 1 year. Sometimes we will allow 2. That's up to underwriter, depending on the loan size and depending on the taxes due. But we don't really shy away from borrowers who don't pay their taxes. But as a requirement, since the IRS lien would go primary to our first mortgage, we are required to settle them on the sheet. And then light appraisals. Light appraisals means borrowers or sellers believe the value is higher than what the appraisal comes in. Typically, borrowers don't go out and look for comps. They have a feeling of what they think their property is worth. When they think the property is worth X and the property comes in worth less, they want to know why. Typically, it's the comps from the appraisal. So we will explain to the borrowers why the appraisals have come in short and why the market is not as aggressively pricing their property as they think it is. Verification of funds. This is the one we talked about with Alan already. The verification of funds is, does the borrower really have the money for the down payment, for the closing, and the reserves? We've spoken to that already, and I think that we can pass on that one now. Mortgage history. We've spoken to this before too. Borrower lates. Lates on mortgage history show us character of the borrower and their ability to repay the loan. And if the seller misrepresents the property, the appraiser discovers that the reported figures are not correct. If the borrower says they're getting $6,000 in rents per month and the appraiser asks for leases, they show them the leases and they only add up to $5,000. That's one of the biggest problems that we have, that the seller says, oh, well, I'm going to raise the rents next month. We can only underwrite the historical data. We cannot underwrite anything that may or may not happen in the future because we're not sure it actually will. So now we get into marketing and sales. I don't know if Alan has shared with you yet, but I gave Alan a couple pieces of marketing that we use for our external referral sources. Those external referral sources will be going over in this presentation. In-house referral sources, stay focused on your people, stay focused on your sources, stay focused on your plan. Canvassing the neighborhood. Anytime you drive by and you see a for sale sign on a property, right there, number one, you see that the property is available for sale. You know that the property is probably looking for a lender. The seller is looking for a lender. And you're also going to get a real estate agent information that's from that sign. And then set goals for yourself. So by setting goals, we say you make 2-3 contacts per day, send out 5 emails per day, or whatever your plan may be. So for the external referral sources, just the other day I sent Alan some information and some sheets that are for sending out hard mailers and email campaigns. They're for bankers, associations such as the Real Estate Association, attorneys associations, realtor association, accountants and their association. All these are considered external referral sources. The insurance agents, title agents, everybody that comes in contact with you during the processing of any particular loan is considered an external source. In-house referral sources. You're going to see that when you start generating documents, you're going to see business cards, email signatures, 1003s, brochures that you receive from other parties advertising their services, and voicemail messages. All these are pretty self-explanatory as in-house referral sources. So staying focused means working on real deals. The things that I've covered today, and I've covered pretty quickly, are what enables you to figure out and triage the deals yourself. No one wants to work on deals that don't work. If you need help figuring out whether a deal works, If you go back to the beginning of this program, you'll see some of the things that we use to qualify the deals. If any of those things become hiccups or hurdles, you'll know that those deals may not be real and they may be fake. The biggest thing we see in this business is what we call the white whale. It's a deal that comes in that's $30 million. If you're seeing the deal for $30 million, the first thing you need to ask yourself is, why am I seeing the deal? Is it a real deal? Is it really out there? Are the borrowers putting in any of their own money? Are they looking for 100% financing? There are many reasons that deals like that float around the industry, and everybody has seen them. I can tell you that we've seen deals like that sometimes from 10, maybe 15 different mortgage brokers all saying, what do you think of the deal? If the deal has old information in it, and say it's from, well, it's a little early in the year, but let's say it's from the middle of last year. If information's from the middle of last year, it may not be a real deal because everybody's been working on it for the last 9 months. So the appraisal is key to any deal. And you'll find that out once we get farther into this. Now, canvassing the neighborhood is one of the other things that we said. Be on the lookout for commercial properties for sale, especially if it's been on the market for a while. If it's been on the market for a while, either the price is too high, it doesn't have qualified borrowers, but because it's been there, it gives you the information that you need to find a realtor's sign that has the realtor's information, contact him or her, ask if financing is the problem. Maybe the borrowers aren't getting financed because there's a problem with the bank. So tell that person how you can help. So setting goals. This is what our goals are in our office. We look for at least 3 referral relationships per deal. We like to make face-to-face calls on at least 3 possible clients per week. In this day and age of social media and emails, it has gotten lost somewhere in the process of talking to people in person. It's just like a thank you note. When someone sends you a handwritten thank you note, you go, wow, that was really nice. They were really thoughtful. Same way happens when you do face-to-face. So our team does face-to-face calls on people in their area, typically 3 times per week. Utilize your leads list. If you have leads list or you generate or buy leads, keep it simple. We have the 2020 plan, 20 leads in 20 minutes for email. That's it. So those leads, you can harvest different information from those leads. Typically, we try to stay away from most leads lists that are pay for play, which means they want a percentage of your fee. Usually you can get a leads list by going to an association. Go to the real estate association in your area and you get a list of all the realtors. Go to the local attorneys association, you can get a list of all the attorneys. Typically they help their clients by getting financing, and then most of the times when they're helping their clients, it's a deal that you can do because it's a deal that the bank can't do. So our commitment to you and our commitment to Alan and the team is we provide marketing support. Alan will have a couple pieces to distribute to you somewhere down the line. We have training, which we're doing now. We have incentive programs or specials we run, which are for either the account executives or for the borrowers. Sometimes it's free appraisals, which helps you sell a deal. Sometimes it's appraisals paid at closing, different things that we offer to you and to the borrowers. You have a direct and immediate contact with all of us. I'm not sure if you know what my position is, but I am the managing partner of the company. I am the one who does training seminars and runs the money for the company. You'll have account executives with Alan and his team, and Alan will deal directly with us. We have face-to-face personal relationships. This is the first face-to-face we've had tonight with all of the team. I understand it's electronic, but it's better than the old days when we all used to just talk on the phone. And we have sales support via conference calls. One of the biggest things is, if you remember, we said no phone, no loan. If you talk to your borrowers on the phone, and if for any reason you need assistance in qualifying the deal or want to arrange a conference call, you do that through Alan, and we can help arrange the conference call. Either Alan and his team will do it with you, or we will assist in that call and get you what you need so that way you can have the answers. Now, that sales support via conference call is a great tool because it allows you to shadow us as we talk to the borrower. When we talk to the borrower and you find out what we say, what we ask, and what our concerns are, you know for the next time what your concerns are and what you need to handle. So it's a great part of the relationship and something that most people don't do. And I'm not sure that any bank will give you the opportunity to get on a conference call with them because they're very difficult to reach. So that's it for my speech tonight, my presentation. If there are any questions or answers you need, let me know. Alan, if you want to take me off share, I think we can do the Q&A.
Okay, great. Well, thank you so much, Carl, for a lot of the insight. So, guys, this is actually this is the other side of the table, right? So all of us, we are actually sitting on one side of the table, which is out there generating leads and things like this. And Carl is actually sharing with us how they, as a lender, sees a deal, how to get the deal closed. So the first questions that I have for you, Carl, is that I run into this a lot. When someone sends us a deal, the first thing they ask for us is that, hey, Alan, give me a rate and term. Let me know. Hurry up. Why are you taking so long? Okay. So I do my best to explain to them why it takes a long time or it takes time to get a rate and term out. So basically, he's saying that, hey, out there's a lot of lender can easily throw you a term sheet. They can say, hey, I can give you 6%, 5%, 7%, whatever that might be. But what way is it for that term sheet to hold, right? We can generate a term sheet all day long. But I know that with you guys, we do not do this. It takes time. So from your perspective, share with us, why does it take time for you as a lender to just provide us a soft quote?
Okay, the reason that we do it is we don't issue what's called a sales quote. A sales quote is someone throwing out a number that they never achieve. What is my rate going to be? Well, we'll give you a rate. It's going to be about 7%. Well, why is it 7%? That's not what happens. We look at every single factor. We take into consideration for a soft quote, we take into consideration the property type, the property location, the asset of that the quality of that asset. So what I'm saying is, if you have a rural property, for instance, a rural property has an add to the rate because it's rural. So we need to set realistic expectations for that. If the borrower has 720 credit, but 725 is the next credit tier for better pricing, we have to take that into consideration. If the borrower has one vacancy in a 5-unit property, we have to take that into consideration. So there's less income to come in. So what happens is now we're adjusting the loan to value based on income. We're adjusting the rate based on credit score. We're adjusting the rate based on location and quality of the asset. And all of these come into play. So while it's easy to say, okay, I'm going to throw a dart at the dartboard and here's the rate, we don't do that. When we give you a rate, we'll give you a soft quote and it'll give you a range. The range will typically be 1%. Once we have that range and we narrow in for an official quote, we lock that quote until the appraisal comes in. As long as the appraisal comes in at value, we accept that value. You get a courtesy rate lock from us since the day we offered the quote. So all of ours are given as underwritten rate quotes. So we don't do sales quotes. The sales quotes only create problems for you and create problems for us. So when you set realistic expectations from the beginning, that's why we take a little bit longer. But it's not hard. If you give me the profit and loss, you give me the application and the credit report, or you want us to pull credit, and you give us a signed authorization, we will. We can usually get you a price within 24 hours. So we'll set realistic expectations within 100 basis points. But that's one of the biggest things we get. We get an email. Hi, Carl. Here's the address. Here's the purchase price. I have a 720 score. What's the rate? I say it all day long. So, it's difficult to break a habit, but that's a habit of everybody in the business.
Right. So that is what the scenario form is all about, ladies and gentlemen. That's why we designed the scenario form for a purpose, because again, we do need some basic information in order for us to understand what that deal is. So make a habit to, every time before you pick up the phone and call us and asking what the rate is, ask your client, just take 1 minute, fill out the scenario form. Once we have the basic information, what the address would be, what's the value of the property, what is the rent roll, what is the property tax, insurance, credit score. so on and so forth. Once we have that information, now it will give us enough data to send it to Carl so he can price the loan for us instead of just pick up the phone. Hey, just like what Carl say, hey, my credit score is 750. What can you do? I don't know what I can do until I hear more detail from you. And quite frankly, right, Carl, share with us because, for example, like the restaurant deal that we closed, right? So at the beginning, even though we got a soft quote, but during the process, we still have to do a lot of structure because again, at the beginning, they came in with a structure like this, but during the process, you find out there's more issue with that particular LLC, and now we have to convert to another LLC. So we see it all day long.
Yeah, the typical thing that we see when we do the loans is most properties in commercial should be purchased or refinanced in an LLC or corporation. When we get into that, we start looking into those LLCs and who the members are. Borrowers don't always disclose all the members. They usually take the borrower that has the best score and say, hey, I'm the borrower. What happens is we look at every borrower that's part of that LLC. And every borrower must at least be a qualified borrower. When we do LLCs and there is a borrower that is not qualified or they want to remove someone, we can change the LLC midstream, which is what happened in the case of that restaurant.
Yep.
The one borrower did not have enough to qualify. I forget whether it was whether it was trade lines or capital or what the deal was, but they wanted to bring in another borrower. By bringing in another borrower, we created a new entity. So we changed entities midstream. That's not a problem for us. We just want to make sure that by the time we get to closing, we have an approved entity with approved borrowers. So, like Alan says, we can always adjust accordingly. Just as long as we have a place to start, and as long as we sign up a deal, we'll get them to the closing table if it's able to be closed.
Right. So again, that shows the flexibility of our lenders. If the client would go to a traditional bank, and once that thing doesn't work out, and once a borrower does not qualify, guess what? They would just shut them out, close the deal, killed it, and that was it. They're not willing to help you to think of a solution. And that is what Sequoia is all about. It's not just about providing a rate to our client. It's actually providing a solution for our clients to get the property that they intend to get. For example, like the gentleman right there that with the cash, if we shut them down and guess what? He is not able to purchase that property. He's going to lose his deposit and he's going to hate our gut for the rest of his life, right? But guess what right now? We are able to help him to provide a solution for him, even though the interest rate is much higher than the bank. He's still very appreciative. And now he's just telling me that, hey, Alan, I mean, from now on, all my deal belongs to you. All my friends' deal, I will come to you. It's just because that extra 10 miles that we walk through the deal with him and the lender. So that is what the Sequoia platform is all about. And that's why I very, very appreciate that, Carl, that you come in here to share your insight with us so that our team, our member can see that what kind of lender that we're dealing with. It's not like, think about this. If you're working with a bank, ask them to 8 o'clock at night to come up here to do a presentation, forget about it. They're not going to do that. But hey, with Carl, I mean, they are willing to talk to us anytime, right?
Yep.
So
And
we have
Alan, I really
Yeah.
appreciate your time putting this together. And I appreciate everyone's time on this call. I mean, that was an hour of time. I know it was only supposed to be 30 to 40 minutes, but I tried to get it in as quickly as I could. But I really appreciate everyone's time tonight.
absolutely. Any other questions? Demetrius, go ahead.
Yes, sir. Yeah. Hi there, Carl. Pleased to meet you. First time seeing
Good
you.
evening. Nice to meet you as well.
Yes, sir. Got a question. I represent a gentleman that owns a corporation with, they're not really tiny homes. They're prefab homes that come together in kit form from China. He's got a direct contact with two corporations in China. And they come over here and we've got like colonies that want to build these prefab homes. They're cottage houses. They're 2-story. They're threeplex. They're fourplex. And we have one tiny mansion home. And is there any problems if all the the things that financials are together? Do you have any problem? There's about 25% as tiny homes that we offer, but it's not a big part of our.
We do have a problem with tiny homes.
Okay,
Our credit policy.
Okay,
I'm
we're
sorry.
not. I'm sorry, we're not 100% tiny homes, sir. We're
Okay,
mostly
but
prefab houses. Good.
okay, as long if they're prefabbed, we don't have a problem with prefab if they
Okay.
meet the guidelines.
Yeah.
Manufactured homes which we call manufactured homes. In most cases, depending upon where we put them and how the project is done.
Yeah.
If it's done in a mobile home park, I cannot do it. And the
Okay.
reason being, in a mobile home park, a
Mhm.
manufactured home is considered personal property, not real property, so it cannot be secured by my first mortgage.
I see.
In a development project with 1 to 4 unit residentials, it is looked at completely different.
Mhm.
So now that we look at that differently, we are able to finance that through normal channels.
Okay,
But
most of our communities will be anywhere from 15 to 40 or 50 non-manufactured prefab homes. And the second part of my question is, will you do any funding in another country in South America where they want
No.
450 houses? No?
no, we lend in 46 states.
Okay. Okay.
Nothing outside the country.
Okay, so what about the other ones? The smaller communities of prefab homes, like 40 to 50. We got 2 of them in Florida we're setting up now.
Well, Florida, it's very common in Florida. Yeah, I'd have to see where they are. If they
Okay.
are in what we call metropolitan statistical areas, MSAs, that we can do, we would consider it. But if it's in a non-metropolitan area or it's rural, they're
Yeah.
not permitted for us.
These two developments are Parker, right outside of Orlando, and the other one is Melbourne, right next door to me.
Oh
And
yeah, okay, yeah,
that's
they're
30,
fine.
that's 78,000 people.
Yeah, those are fine areas. Yeah, and
Okay.
if I can't do it, we have contacts all throughout the country that provide the money for that, and I can give that to Alan, and Alan can get it done for you.
Okay, thank you, Kyle. Appreciate your help.
Yeah, we're always willing to give you a referral to another lender that we know will get the deal done for you.
Thank you. Thank you.
Yes, sir.
Okay, we have time for one more questions. Anyone take the last one? Okay, if not, then well, thank you so much. And again, welcome to another episode. Next week, if you are serious, next week, make sure that you come on to our training for next week, because next week we are pushing out a new program. It's the wellness program that we can help small business owners to provide free benefit for their employees. Okay, so next week we are going to be talking about that and launching that new program. So until then, thank you so much. Thank you so much, Carl. Thank you so much,
Yes.
everyone.
Thank you, everyone, for your time.
And I see you next Wednesday night. Good night.
Thank you. Bye-bye.
Thank you. Bye-bye.